Hi, this is Brett with Monarch Capital Home Loans, and today we want to talk about points and should you pay points? This is sort of the classic question when people are buying or refinancing a home and they're trying to decide whether or not they should buy the rate down and so forth. But let's start by talking about what a point is because there is some confusion about that. A point equals 1% of your loan amount, and I suppose we just say point because it's faster than saying 1% all the time. But you can see that this adds up pretty quickly. So even though it sounds small on a $350,000 loan, for example, 1 point is $3,500. 1.5 is $5,250, and all the way up to say 3 points, so you're looking at $10, almost $11,000. So even though a point is small on a relative basis, on an absolute dollar basis, it can get pretty big pretty fast. Now, why would you pay points? Well, generally speaking, you pay points in order to get a lower rate. Now, in some other videos, we've talked about how loans get priced, and if that's confusing, it might be good for you to watch that video real quick. But in this illustration, I'm just giving you an example. These aren't real numbers by any stretch of the imagination, but you can see that you might have a choice as a consumer between getting a rate as low as 3.875% by paying 1.5 points at a cost of $5,250 if your loan's $350,000. All the way up to 4.375 where there's no costs. In fact, you can even do it a little bit higher, 4.5, where the lender starts to pay for your closing costs through a lender credit. So the bottom line is you have a lot of options, and generally speaking, you're paying points and incurring more expenses in order to lower your rate. But should you pay the points? Well, let's say that you wanted to compare a 3.875 rate that got you under 4% with 4.25. And at 3.875, it's 1.5 points, almost $5,000, versus 4.25, which is about $1,000. Well, the way that you would want to look at this, I think, is you want to look at the difference in payment. In this case, what you see is the difference in payment is about $56 a month, and the 3.875 costs about $4,300 more. But should you do it? Should you do it for the $55 a month? Now, some people would say, heck no, but let's look at this. Really, the way to look at this is just to divide the additional cost by your monthly savings to see when the payoff is. And in this case, what this is saying is that once you hit 6.5 years, having the 3.875% would really save you money. But it would take you 6.5 years, more or less, to break even or for that payoff to happen. And so the question always comes down to the same thing. It always comes down to how long are you going to be in the loan. If you think you're going to keep that 3.875 30-year fixed loan for over 6.5 years, 10 years, 12, 15 years, then the math pencils out. It makes sense to do it. If you're not, then you shouldn't. And you should be realistic because most people stay in a loan really no longer than 6 to 7 years. Now, this may be an exceptional time with the very low rates that we have been experiencing, but it always comes back to that math, and you want to talk to a loan consultant who can kind of work you through some of those scenarios and numbers so that you make a good decision for you and your family as to whether you should pay points.